The discretionary trust is Australia's favourite family structure, flexible, familiar, and at the centre of tax planning for generations of business owners. It is also, right now, at the centre of the ATO's attention. I am Tin-Lok Shea, tax lawyer at Australian Tax Experts. In this presentation, we will cover the key risk areas every trustee needs to understand. Section 100A, the anti-avoidance rule with no time limit and a 47% price tag. The distribution patterns the ATO has flagged as high risk. How the High Court's Bendel decision has just made all of this more important. And the paperwork discipline that quietly decides many of these cases. If you are a trustee, or you advise one, the next 10 minutes are for you. Four numbers define the risk. 47%, the rate at which the trustee is assessed if Section 100A applies. Top marginal rate, including the Medicare levy, with the beneficiary's entitlement simply disregarded. No limit, the amendment period for Section 100A assessments. Unlike almost everything else in the tax system, historic distribution years effectively remain open to the Commissioner, however long ago they occurred. 2026, the year the High Court's Bendel decision took unpaid present entitlements out of Division 7A, prompting the ATO to point straight at Section 100A as its remaining tool. And the 30th of June, the deadline by which every year's distribution resolution must be made. Miss it, and the consequences arrive regardless of anyone's intentions. Why the scrutiny? Start with the structure's own success. Discretionary trusts let a trustee distribute income to different beneficiaries each year. And that flexibility, the very feature that makes trusts attractive, is exactly what draws the ATO's eye. The concern is specific. Distributions that appear designed to reduce tax, rather than to reflect genuine economic relationships. Income streamed on paper to whoever has the lowest marginal rate this year, while the real benefit flows somewhere else entirely. And this is no longer an abstract concern. Since 2022, the ATO's framework has been set. Taxation Ruling TR 2022/4 states its view of the law, and Practical Compliance Guideline PCG 2022/2 sorts trust arrangements into coloured risk zones. The audit program follows those documents, which means trustees can and should read the map. Now the provision itself. Section 100A is triggered where a beneficiary is made presently entitled to trust income under what the law calls a reimbursement agreement, an arrangement under which the economic benefit of that entitlement passes in whole or in part to someone other than the beneficiary. The consequence is severe. The beneficiary's entitlement is disregarded, and the trustee is assessed on that share of the trust's net income at the top marginal rate, 47% including the Medicare levy. No franking, no discounts, no beneficiary rates. And then the feature that makes Section 100A unique among the ATO's tools. There is effectively no time limit. Assessments under the provision are not confined by the ordinary amendment periods, so distributions made many years ago remain within the Commissioner's reach. A risk with no expiry date deserves a review with no delay. Here is the pattern the provision was written for, in 4 steps. Step 1. The paper entitlement. Trust income is distributed to a beneficiary on a low marginal rate, an adult child at university, a retired parent, a company with losses. Step 2. The benefit is diverted. The beneficiary never really receives the money. It is paid to, lent to, or simply kept by the trustee or another family member. Step 3. The purpose. Viewed honestly, the arrangement exists to reduce the family's overall tax, not to benefit the person named in the resolution. And Step 4. The consequence. The entitlement is disregarded, and the trustee is assessed at 47%, usually years later, with interest running. The pattern is common because it works arithmetically. Section 100A exists precisely because it works arithmetically. The ATO's guidance names the patterns it considers high risk, and they will sound familiar to anyone in family business circles. First, and reddest of flags, adult-child distributions. Entitlements to family members with low marginal rates and no genuine economic interest in the trust, who never actually see the money. The classic case is the university student distributed $100,000 on paper, while the parents keep every cent. Second, distribute and loan back. The beneficiary receives their entitlement, then promptly lends it back to the trustee or another beneficiary, the money completing a round trip that changes nothing but the tax. And third, corporate beneficiaries on paper. Bucket company entitlements where the funds are never actually paid across or used by the company. If your trust's history includes any of these patterns, it deserves a professional look before the ATO's data matching gives it one. Now the defense. Section 100A does not catch everything. It excludes agreements entered into in the course of ordinary family or commercial dealing. That exclusion matters enormously. Families genuinely support each other, genuinely share resources, and genuinely make distributions that reflect real relationships. Parliament never intended to tax ordinary family life at 47%. But two warnings. The boundaries of ordinary are contested. The phrase has been fought through significant litigation, and the ATO reads the exception narrowly. What a family considers perfectly normal, the Commissioner may consider contrived. And second, the exception is one on evidence, contemporaneous records showing the genuine purpose of a distribution and the real flow of benefit are what make it stick. An arrangement that is genuinely ordinary, but wholly undocumented, can end up looking exactly like one that is neither. And now the reason this topic is urgent in 2026. In June, the High Court handed down Commissioner of Taxation v. Bendel, holding that an unpaid present entitlement owed to a corporate beneficiary is not a loan for Division 7A purposes. A genuine win for taxpayers. The ATO's 15-year-old position overturned. But read what the ATO did next. Its decision impact statement points squarely at Section 100A and Subdivision EA as the remaining integrity tools for trust arrangements involving corporate beneficiaries. Translation: the compliance energy that used to flow through Division 7A now has one main channel left, and it runs directly through the topic of this presentation. Where bucket company entitlements arise and the cash stays in the trust, expect reimbursement agreement arguments to feature more, not less. Bendel was a win for taxpayers and a redeployment order for the ATO. From the dramatic to the mundane, and the mundane loses just as much money. Trust distribution resolutions must be made before the end of the income year. In practice, before midnight on the 30th of June. A resolution made even days later is generally ineffective. And where no effective resolution exists, no beneficiary is presently entitled, and the trustee can be assessed at top marginal rates by default. The resolution must also be certain. The amounts or percentages allocated to each beneficiary clearly identified. A vague income to be distributed among the family as the trustee determines can fail entirely. This is the most avoidable risk in trust taxation. It requires no legal argument, only discipline. If your trust's past resolutions are missing, late or vague, treat that as a live issue for your advisor this month, not a housekeeping item for someday. So here is the trustee's playbook. First, review the distribution history. Test past distributions against TR 2022/4 and the PCG risk zones. Know which color your arrangements actually are, rather than assuming. Second, follow the money. Entitlements should be genuinely paid or properly documented if they remain outstanding. The benefit should match the paper, because that is the exact question Section 100A asks. Third, resolve on time and in writing. Clear certain resolutions before the 30th of June, every single year, kept where you can find them a decade later. And fourth, get ahead of the ATO. Where you find risk, advice and voluntary engagement consistently produce better outcomes than waiting for a review letter, especially under a provision with no amendment time limit. With trusts, the past does not stay in the past. Deal with it on your terms.
At Australian Tax Experts, tax lawyers and accountants handle trust matters as one team. We run Section 100A risk assessments, your distribution history mapped confidentially against the ATO's rulings and risk zones, so you know exactly where you stand and which years carry exposure. We manage ATO audit response, trust reviews and reimbursement agreement arguments handled from the first letter, with the legal and financial analysis working together. And where arrangements need to change, we handle trust restructuring, done properly, and done before the ATO forces the timetable. In a post-Bendel world, every family group with a trust and a bucket company should know its Section 100A position. We can tell you yours.
If you are concerned about your trust distribution arrangements, contact Australian Tax Experts for a confidential Section 100A risk assessment. Visit australiantaxexperts.com.au/contact. Thanks for watching. And remember, this presentation is general information only, not personal tax or legal advice.